Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Amish Shah. He says in a note that was released late last week that he believes that the Nifty could be ripe for a correction. I'm paraphrasing it, not exactly in that terminology. And they're sticking to their targets of 15,000 on the Nifty that they gave, I believe, a while ago when they released that first note, when the Nifty incidentally was at about 14,500. He joins in right now to talk about why is it that they are still sticking to the stance, and are they not making changes to either the growth or the earnings or the multiples which compel them to believe that the Nifty could be on course for a correction. Amish, great having you. I hope all is safe.
My pleasure as well. Thank you, Neeraj. Good morning to you and your viewers.
Thank you so much, Amish. So, well, from a bull's perspective, listening to you might not be a good morning simply because you're saying that the Nifty might be on its way to a corrective move. What's the basis of this?
Sure. So, Neeraj, if you look at few factors that concern us, first, obviously, as we all know, macro risks are now rising. There is already a talk about tapering to start in the US. I know that's a debatable point, and we'll get to the details of that. We are also taking a view as a house that US dollar is likely to appreciate. Both of which, so if the tapering starts, then the US bond yields go up, and the US dollar depreciation, both of that is a negative news for markets in India. Second, if you look at the retail participation as a percentage of volumes, they've been consistently up. And especially given that the mid-cap, small-cap valuations are now at the peak, and given the fact that the recent IPO listings have not been that great, all of that could point to a pressure for the levered retail positions, especially. Third, if we look at the earnings, specifically within the materials sector, energy sector, and consumer discretionary sector, we do think that there is a risk of downgrades. And again, we can get into details as we go along. We have done some kind of a trend analysis of the market cycles over time. And interestingly, what we've seen is that once the market rallies over 75 weeks, generally the market momentum weakens. We are in the 74th week, by the way. And, the average returns is about 106%. We are already at 120% returns. So obviously that's not a fundamental analysis, but, that is what the trend suggests from the past cycles as well. And all of these concerns in the context of valuations, we all know that the market valuations are not cheap for the headline index as well. And more particularly, some of the sectors where the valuation expansion was only on the back of the fact that the cost of funds globally is cheap, and therefore your DCF valuation should go up. I think that will start to get questioned now. So those are some of our concerns. Obviously, we are not negative on every sector. We are being selective bottom up. But for the headline index, we do think Nifty, as you said, our target is 15,000 for the year end. And that implies about 10% downside from where we are.
Okay, so Amish, can I ask you from the last time that you gave out your note, which spoke about the Nifty at 15,000, we were lower than that, and you believe that the markets will get contained to 15. To now that we're back to whatever that we are at about 16, 16.5, has the hypothesis on any of the themes changed? I heard you make a very interesting point that there were some spaces on which the valuation re-rating only happened because of easy liquidity, and that might change.
So, there were some fundamental reasons and some only valuation re-rating related. So coming to the fundamental reasons, I think the markets definitely surprised over the last 2-3 quarters on the back of consolidation happening much faster. We ourselves were proponents of consolidation and large becoming larger, organized guys gaining share versus the unorganized guys. So we still believe in that, but the trend or the pace of the consolidation was much faster. Second, companies have been able to keep their costs under control. They've been able to convert their fixed costs into variable costs. The thinking earlier was that as the economy opens up, costs will start to go up as well. But that actually didn't happen. The corporates managed that quite well. And the third is that despite the massive spike in commodities, if I were to put it that way, for instance, steel is one of the key commodities for most companies within Nifty, and steel is up 70%, since June last year. And despite that, while the margins have got impacted, it has not got impacted to the magnitude that one expected. So all of that is to the credit of the companies, and on the back of that, some bit of earnings upgrades were justified, which is obviously taken the markets higher. But then obviously there are other factors linked to purely valuations getting re-rated, and predominantly only on the back of the fact that there is a lot of liquidity, cost of funds globally is cheap, and therefore if the cost of money is cheap, the valuation should go up. So that hypothesis especially, we think may now get punctured.
So Amish, just focusing a bit on that before we move on to the larger, broader bucket as well. Where is it that you find a combination of both the risks in that while margin management was good until now, what if that gets challenged? And add to that the valuation re-rating due to higher funds, if the funding comes off, might also get challenged. It's an unknown. So I understand you may not have 100% certainty there, but just working with the hypothesis, where is it that both the things kind of work against the theme?
So consumer discretionary in our mind is a sector right at the top. Just to give you some statistics, back in January, we had looked at all the annual reports of 50 companies within Nifty. First of all, we realized that obviously services companies are not exposed to commodities at all. So that part is safe, like IT, financial services, they're all services. So they have nothing to do with commodities. Within the pack that is linked to commodities, consumer discretionary comes right at the top. 57% of sales within the consumer discretionary sector is commodity cost. And that is the highest. On an average, you have most other sectors. On an average, it is between 20 to 30% of their sales, which is commodity. Consumer discretionary is 57%. Now, in an environment where the demand is very robust and the discretionary spends are happening, this is not a worry because companies are able to take price hikes. These are all good brands. They have good products, they have good franchisees, and they can take price hikes and pass it on. But this is not that environment. Clearly, the demand in a lot of sectors, you look at autos, and I'm obviously talking all in comparison to the expectations built in. So I'm not trying to say that the demand is completely lackluster, but versus what the street is already building in, there are disappointments. Right. So in the environment where the demand is relatively subdued, the ability to take price hikes to completely pass on the cost pressures is not there. And that, along with the fact that you have a higher percentage exposed to commodities, is a risk. And on the other hand, if you look at their earnings expectations, without getting to the names of the stocks, but in cases of certain stocks, the expectations is for 150% earnings growth over the next couple of years. Right. I understand that there is a low base effect, and I'm talking about large cap companies, not mid cap companies here. So 150% earnings growth and the valuations versus pre-COVID has expanded by 50 percentage points. Right. So that to us is a scary construct where you may not be able to take price hikes. Consensus earnings are too high, maybe to justify high valuations, and despite that, the valuations look quite pricey. So consumer discretionary, I'll definitely put it up there. The second sector I would probably say is sectors linked to commodities. So far, commodities were seeing a rally. Now, if the US treasuries rise, and obviously it is all linked to whether the US treasuries rise, but if that does, then the money gravitates towards a safer asset, which is US treasury, considered to be US treasury. And the liquidity-driven commodity rally may start to get reversed. We've already started seeing some signs of that. You would have seen crude and copper have already come down by about 10 plus percentage points recently. Now, if that happens, remember that earnings for commodities companies are very sensitive to the prices. So if the prices start to roll off, the earnings downside for them will be outsized. So this includes your commodity companies linked to energy sector, steel sector, cement sector, all of these.
Interesting. Just a couple of questions and pointers, if you will, on discretionary. By the way, your note yesterday on some of those names. You don't want to. I'm not asking you to talk about names. I'm just saying your note on Havel, Tata, etc. Was probably symptomatic of the view that you just gave. But I just have a quick follow-up there, Amish. We were talking to the MD of Gujarat Pipavav Port yesterday. and he mentioned that the disruptions caused due to freight raise and container rates for all things which add up to the cost of companies on the exporting side. He believed this disruption is a new normal which people should anticipate to last for a better part of 2021, if not for a better part of 2022 as well. Would you reckon, therefore, that your thesis about the higher costs for not just manufacturing but supplying these goods as well might keep the uncertainties and therefore the valuations at bay for some of the export-oriented names?
Certainly, yes. So look, India, first of all, if you think from the, again, from a background perspective, first of all, India predominantly has exports which are for consumption within India. So we are not a transshipment hub. If you look at the transshipment in India, it is only at about 5%. So transshipment, just for the simple terms for your viewers, is cargo which is not meant for use in India, but is just getting parked in India for smaller ships to take it away to, let's say, the neighboring countries, right? So the bigger vessels offload the bigger cargo, and then smaller vessels comes in and takes that cargo to the countries that they are meant for. It is not meant for consumption in India. So that kind of volumes in India is only 5%, which basically means that the cargo that comes in as exports in India is relatively inelastic. So irrespective of the prices, you want to consume it. So call it things like your washing machines or air conditioners, refrigerators, mobile phones, textiles. So all of these things is meaning, yes, you would worry a bit if your mobile prices go up by 5% or your refrigerator is going to cost you 2-3% more. But the fact is that if you need it, right? So to a large extent, they are discretionary consumption items, but to a large extent, a couple of percentage points on the back of logistics costs going up is not going to really impact the consumption in a big way. So I don't worry about sea freights going up. I think the exports that are meant for India will continue. But the kind of other commodity costs that we are talking about, like steel, crude, etc., that does definitely have an impact on the discretionary demand. Like call it within automobiles, you may, if your car is going to cost you 10% more, chances are that you may want to postpone that buying decision.
Yeah, for sure. Okay, the other counter to your point on energy, and I just wanted to understand from you here, when I speak to a lot of your peer set as well, are they and the companies as well, Oil India, for example, they say that for FY21, the year as a whole, the average crude realizations were parked in at about $40. They are penciling in only $60 and still expecting earnings growth, whereas crude is certainly northwards of $60. And if the gas price revision that is scheduled to happen in October does go through as expected, then it will be a big earnings booster for the second half for the upstream names. You don't concur?
So the gas price hikes we do concur. But obviously, as you know, that has got delayed by about 3 to 4 quarters. So every quarter we keep hearing about it and it keeps getting rolled forward. But I agree that as and when it happens, it is a upside for the gas-based upstream names. In general, otherwise, I agree with you that the stocks in the energy space is cheap. But generally there is always a PSU discount. Given that these are regulated sectors and at sometimes regulations can be averse for these companies, so they are never priced to the fair valuations. It is not now. You can probably see it over longer history. Unfortunately, they always trade at a discount. So if you keep the discount constant, in that context, we do think that if crude comes off, the chances of them coming off is higher as compared to them benchmarking to the 60 versus 65 that you spoke about. Neeraj, you are on mute.
Yeah, sorry. I'll just continue with this sectoral conversation for a couple of more questions and then move on to the larger macro, Amish. In your note, you've said that you are turning overweight on defenses. Now, is this a stance because you anticipate this near-term corrective move? And is this therefore a very short-term call which would be led predominantly by the market movement, and once it reaches particular levels from where you might be neutral weight or overweight again, that could change?
Absolutely, Neeraj. So first of all, our cautious views on the markets is also near term, and that's why we call it as a tactical call. We expect so we expect predominantly that if the taper happens, it may happen by November this year. So that event itself is more near term. And if the taper indeed does happen by November, then the markets may start having a pullback quite immediately. So over the next 3 months, we are cautious. And if the markets are going to correct, obviously you want to hide in defensives at this point in time, where the earnings dispersion is most is very narrow, or in other words, the confidence on the earnings delivery is very high, right? So those are the names that you may want to stick on when the markets are correcting. Once the markets have corrected, our preference is obviously to own the cyclicals, which is particularly financials and industrials. Those are the two sectors that we really like.
Okay, so for now, you are moving away from there tactically and barking yourself in defensives. You could change that stance depending on the situation then. May I ask you about technology, because I think you had slightly contra views on tech. There, the earnings delivery doesn't seem to be under challenge, so to say. What's your call here? Because in your note, I saw defensives, I saw materials, I saw industrials and financials, and large caps versus mid caps and small caps. What about technology?
So technology, we are overweight as well. To your point, in fact, the US dollar depreciating helps them. There is a good visibility on their earnings. So that is a space where valuations may not matter near term. And the valuations are expensive, but they are not crazily expensive anyways. So, so specifically staples, IT, utilities, and healthcare are the sectors where we are overweight within the defensives. Within the cyclicals, we are overweight on financials and industrials. Telecom, we are more like a neutral weight right now, because what happens to the oligopoly or the duopoly situation in the industry, one doesn't know yet. And materials, energy, consumer discretionary are sectors where we are underweight.
Okay, Amish, couple of questions again on the index, and then I would want you to talk a bit about the capex theme, which I believe you're materially overweight on over the long term. One, while this tactical call of Nifty to 15,000 is more based on the factors that you outline, what's the probability or what are the causes for this to overshoot on the downside? Could something change? Something that you envisage right now, of course, what you don't envisage, you obviously can't comment on, but something within what you envisage, is there a probability of these targets getting extended due to reason X or reason Y happening?
So again, look, first of all, whether taper will happen or not itself is a question. Then the second question is, which kind of bonds do they start to taper? Because there are many assets like mortgage-based securities, government securities, etc. So there are many kind of assets that the Fed is buying right now. So which kind of assets do they start to taper down is the second question. Third question is at what pace and at what intensity. So currently, the asset purchases are $120 billion per month. So is it going to be a slower taper? Is it going to be a faster taper? At how frequently is going to be a taper? All of these are questions where one doesn't have an answer. To just give you our views right now. So on the bullish side, if we were to go wrong, we are of the view that the current 10-year bond yields, which are at 1.33%, may come down to 1%. So bonds rally, yields come down to 1%. But on the bearish side, we think that the bond yields in US will go to 2%. So 1.3 going to 2%. So clearly the risk of the downside is more skewed in favor of risk as compared to upside. And that makes us more cautious rather than bullish. So the chances are that if we go wrong, markets may rally another 3-4%, because any which ways valuations are now not being supportive. So we see a lower upside, but if the markets were to fall, we are talking about Nifty falling by 10%, some of the sectors on which we are underweight falling more than that, and mid and small caps falling even further. So the risk of downside, we think, is more outsized as compared to the risk on the upside. And that's why we've gone more on the cautious note, despite it being a debatable issue at this point in time.
Amish, some of these you may not even have under very large active coverage, because you would probably be looking at really the top end of the market. But there are some pockets wherein which are necessarily mid-cap, which are getting reasonable government support as well, as in the case of PLI schemes or some other textile bonanzas, for example. And there is tailwind in terms of the earnings growth projections that the management themselves have made. Forget what the analyst community is doing, because there's very little coverage out there. My question is, while you are largely negative on mid caps and small caps, would there be themes that you might have recently gotten under your coverage wherein you might believe that these could be outliers? It could be due to PLI, it could be due to other benefits, or it could be just due to this whole China plus one drift that we're seeing, for example, in specialty chemicals or APIs.
Absolutely, Neeraj. Again, so there will always be the bottom-up ideas, and specifically on the PLI schemes that you speak about, the government has come out with 13 such schemes. We are actually already seeing traction within 4 or 5 of those. So if just to recount them, so let's say pharma, specialty chemicals, consumer electronics, and within consumer electronics there are many schemes, like one for mobile phones, one for the white goods, and so on and so forth. So the whole of consumer electronics pack and food processing, so these are sectors where we are already seeing progress. Some of the other sectors, like let's say textiles that you mentioned, we think that the PLI is great, but that sector will also need power distribution sector reforms, because power is one of the key input or one of the big costs for textile industry. So if you have a power distribution reform come in, that along with the PLI scheme becomes a very good combination. 100%, there are certain bottom-up themes. We spoke about consolidation, and remember, consolidation is not necessarily only for the large cap stocks. There are many stocks which fall in the mid cap category, but within their industry, they are market leaders. So clearly those are the industries or stocks which will continue to do well. But our concern is, let's say, in our report, we have done some screens where retail ownership has gone up more than 300 basis points or 3 percentage points. And these are companies with very poor fundamentals. So these are companies which are making 0 to negative ROEs. They're making negative free cash flow yields. They have very high leverage. And even these stocks are trading at all-time high valuations. So those are the kind of stocks, clearly one needs to worry. So it is going to be more bottom-up. I'm obviously not saying that everything comes down together. But we see more stress in general within the mid and small caps in comparison to the large caps.
Okay. And it's interesting that for the first time in so many quarters, years maybe, that what the retailer is doing is proving to be the key conversation point and the key reasons, or one of the key reasons for the market direction up or down. Maybe globally as well, not just out here. One final question, Amish, and that is towards what could withstand pressures. I mean, even if the Nifty were to shoot on the downside, what is that theme which could, if not withstand the pressure, then at least be the pond in which people should fish in? And I presume you guys are extremely bullish on the capex theme. We did a whole show on that, by the way, Amish, if you remember. But can you enumerate, because it was maybe 3-4 months ago, what is it that has stood out for you? Why do you like this? And where should people keep a close eye out for?
So, Neeraj, first of all, thanks for that show. And in fact, since the time we spoke, I think we have only gone more bullish. So let me add to some more points on that. So, first of all, we think that India is just beginning a multi-year capex cycle. We call this as a 2003 moment. If you recollect, the last time the capex cycle went up was back in 2003, and the cycle lasted for 9 years. And then this is generally what we've seen, that once you have an upcycle, the cycle generally is between 5 to 9 years, right? So we think that we are just at the start of it. Why is this important? This is important because we have seen that over the time where the cycle goes up, margins in the sector generally double. Working capital cycle comes down by a fourth, comes down to the fourth. So if your working capital cycle is 100 days, it comes down to about 25 days. And your ROEs triple. So last time when the cycle did well, ROEs went triple, and for the sector the ROEs were more than 30%. So that is the importance of that. And obviously, if your earnings growth spike, if your margins spike, if your working capital comes down, and if your ROE goes up, obviously the valuation multiples will also go up, right? So you get a combination of earnings going up and the valuation multiple going up, and therefore you make an outsized return in the sector. So that is the space where we think the sector is in. Coming to why do we think like that? So first of all, if you observe, India is perhaps one of the only large economies globally which is trying to revive the economy by doing a supply stimulus, which is infrastructure capex, rather than demand stimulus. We have not gone into demand stimulus at all, right? Point number one. Point number two, this is not lip service. If you observe over the last 7 years, subsidies as a percentage of government expenditure has halved, and that is in order to create room or finance, create more funding availability to finance more capex, right? So the government is actually delivering on that. Third, again, very important point, that the government is rapidly cutting down on monopolies, or it is opening up monopolies. And in India, there are 5 instances in the past where the government has opened monopolies, call it in the highways space, or the power generation space, or airports, or renewables, power transmission. In every instance, we have seen that once the government opens monopoly, that attracts a lot of private and foreign capital, because these are all underinvested sectors. And what we have seen is that in 15-year time frame, the capex in that sector goes up by at least 3-fold in comparison to capex done in that sector over a 6-decade time frame. So 15 years is 3 times 60 years. So that is a kind of an uptick that you see. And why is that important? Because even this time, over the last couple of years, we are again seeing government opening up a lot of monopolies. So to name a few, gas distribution has been opened up, railways opened up, coal mining opened up, defense opened up, airports the government is trying to privatize, power distribution is something that the government is trying to open up the monopoly through a new law that is currently in the draft stage. So there are multiple large sectors where the government is opening up monopolies, and learning from the previous experiences, we do think that will attract a lot of private and foreign capital over time. So that's the third reason that makes us bullish. Coming to consensus earnings, again, if most of us as analysts will always build a linear margin improvement, but the reality is that when the margin starts to improve, it will improve in a step function. So I think over the cycle, not within a year or two, but over the cycle, there is a massive consensus earnings upgrades possible. And from a positioning perspective, if you look at the sector, only the domestics are overweight, but the foreign investors are massively underweight. The only thing that we've seen over the last 7-8 months is that FIIs have cut their underweight by 300 basis points, but they're still underweight on the industrial sector. So as they also become overweight, even from a positioning perspective, I think there's a lot of flow that will get into the sector on the back of people seeing a visible improvement in cycle and earnings coming through.
And you see evidence of this because you speak largely to or only to FIIs. You see evidence of your clients who are hitherto close to that opening up to the possibility.
So I think most of the domestic funds are already bullish on the capex cycle. When I talk to the FII investors, generally there is a disbelief on the ability to do capex. Nobody questions government's intention to do capex, but everybody questions is there funding availability to do capex. And we've done a lot of work on proving that there is funding availability as well. But the short point is that there is a little bit of a disbelief on that side. And if that comes true, I think FIIs will come around to buy the sector too.
So it's a work in progress. Fair call. But Amish, very interesting note and very interesting interaction with you today. Thank you so much. And I'm glad you put this into perspective that it's a tactical call. It's not something that will really be the long-lasting thing, at least as things stand right now.
Always a pleasure to talk to you, Neeraj. Thank you very much.
The pleasure was ours. Viewers, thanks. Amish, thank you so much for joining in today, viewers. Thanks for tuning into this edition of The Talking Point.